Assalamualaikum and greeting to Dr. Siti. My name is Nur Farah Ayu Nazira, and today our group will be presenting the financial statement analysis of AMWAY Malaysia Holdings Berhad and AEON Co Malaysia Berhad. Our dedicated team consists of 5 members: myself, Muhammad Shamirul, Nur Alia Aisyah, Nur Kuratu Aini, and Resti Hussein. Now, let's take a look for company background. Established in 1976 and listed on Bursa Malaysia since 1996, AMWAY Malaysia Holding Berhad is a top direct selling company licensed by the Ministry of Domestic Trade and Consumer Affairs. Part of the global AMWAY Corporation is enable individuals through direct selling, offering product in nutrition, wellness, skincare, cosmetic, personal care, home care, and home tech. Renowned for quality items like Nutrilite supplement and artistry skincare, AMWAY Malaysia promote integrity, sustainability, and community engagement. They provide extensive training and growth opportunities to the AMWAY business owner, ABOs, to thrive in direct sales. Next, company background for AEON. Established in Malaysia in 1984 as part of AEON Group, a prominent Japanese conglomerate, AEON Co Malaysia Berhad operate diverse retail formats such as hypermarket, supermarket, department store, and specialty outlets across Malaysia. AEON Malaysia offers a wide range of products including groceries, household goods, apparel, electronics, and lifestyle items, focusing on quality and customer satisfaction. With innovative retail concept and convenient location nationwide, AEON enhances shopping experience and maintains its leadership in Malaysia, upholding values of integrity, sustainability, and community engagement. AEON actively supports societal development and adapt its retail offering to meet market needs, contributing positively to Malaysia economy and enhancing local lifestyle.
The first analysis is the liquidity ratio. In current assets, every 1 ringgit of current liability, AMWAY has 1 ringgit and 72 cents in current assets, whereas AEON has only 1 ringgit and 16 cents. So this indicates that AMWAY is in a better position to cover its short-term obligations. Moving on, AMWAY's quick ratio of 51 cents indicates it can cover its current liabilities with liquid assets, whereas AEON's quick ratio of only 8 cents shows it lacks sufficient liquid assets to meet short-term obligations.
Next, we move to the profitability ratio. The first is net profit ratio. AMWAY is more profitable than AEON, with the net profit margin of 8.23% compared to AEON, which is 2.78%. This means that AMWAY generates more net profit for every 1 ringgit of sales. For the gross profit ratio, AMWAY has a higher gross profit margin, indicating that it's retained more revenue after accounting for the cost of goods sold. For the return on capital employed, or ROCE, AMWAY is significantly higher than AEON, demonstrating more efficient use of capital to generate operating profit. For every 1 ringgit of capital employed, AMWAY generate RM 0.48 in operating profit compared to AEON, which is RM 0.05. Lastly, return on asset, or ROA. AMWAY ROA is 18.85%, indicates its general more profit from its asset compared to AEON, which is 2.20%. This suggests better asset utilization by AMWAY.
Next, we look into the efficiency ratios. First is inventory turnover. For AMWAY, it took 6.34 times to turns over its inventory. Meanwhile, for AEON, it took 4.02 times to turns over its inventory. This means that AMWAY turns over its inventory more frequently than AEON, suggesting better inventory management and potentially higher sales efficiency. For the second efficiency ratios is average collection period. For AMWAY, it took 0.09 days to collect receivable from customer. Meanwhile, for AEON, it took 8.47 days to collect receivable. This means AEON collects receivable faster than AMWAY. A shorter collection period indicates more efficient credits and collection management, contributing to better cash flow. Last but not least, we look into the total asset turnover. For AMWAY, for every 1 ringgit, AMWAY able to generate 2.41 ringgit. Meanwhile, for AEON, it for every 1 ringgit, it able to generate 0.78. This means that Amway is more efficient in utilizing its asset to generate sales.
And finally, comparing the leverage ratios between AMWAY and AEON. AEON shows a higher debt ratio, which is 64.41%, while AMWAY is 49.69%, and a significantly higher debt to equity ratio, which is 180.98%, while AMWAY is 98.79%, indicate a greater reliance on debt financing and more leveraged capital structure, which increases financial risk. In contrast, Amway demonstrates stronger financial stability with a higher times interest earned ratio, which is 4.16 times, while Aeon's is 2.45 times. This suggests a better ability to cover interest expenses from earnings and a lower default risk. Overall, while Aeon's higher leverage may offer the potential for higher returns, it also implies greater financial risk compared to Amway's more stable financial position.
As a supplier, choosing AMWAY is beneficial due to its strong liquidity. This means AMWAY can easily meet short-term obligations and pay the suppliers on time. Additionally, AMWAY's high inventory turnover and total assets turnover indicate efficient management and a fast cycle of inventory and assets use. So, this efficiency ensures a reliable supplier relationship. As an investor, Amway stands out with higher profitability. Its net profit margin and gross profit margin are much better than Aeon's, making Amway a more profitable investment. Amway's return on capital employed and return on assets also surpassing Aeon's. So this shows efficient use of capital and assets for profit. These returns suggest better management and growth potential. Overall, Amway demonstrates strong liquidity, profitability, efficiency, and leverage management. This makes Amway a reliable choice for suppliers and a profitable opportunity for investors.